In this video, we'll be going over how to make initial offers when you are going to buy a business. So let's get right into it. So the first thing that you need to agree, or the first thing that you need to determine, is an agreed profit. Now, when I say agreed profit, we need to explain what that means. So agree a profit number. Now remember, when you're buying a business, what you're doing is that you have to explain this to the seller. The person who's selling the business doesn't normally understand this unless they're a experienced business seller. If they sold a business before, they understand this. The business may be producing, for example, let's say a business at the moment is producing for the seller, so for the business owner who's currently owning the business, is making them 350,000 in profit right now. Okay, so when I say profit, I mean EBITDA here. So we're talking about EBITDA, right? EBITDA here. So making 350,000 in EBITDA. Now, when you go to the business seller and say, right, you're making 350,000 in EBITDA, what you're doing is that you're currently making 350,000 in EBITDA. That doesn't necessarily mean that I'm going to make 350,000 in EBITDA once the business has been sold. So you need to look at what you're going to make, right? So the forward EBITDA. The forward EBITDA. This is what's important, EBITDA. And business owners, because they're not experienced business sellers, they don't know what EBITDA is. Most business owners don't know what EBITDA is. Like, we're talking about small business owners, mid-cap business owners, they get a bit more sophisticated. So you've got EBITDA of 350,000, they need to get to that number first for their current business. Then you need to explain to them that, look, you're currently taking a salary of X, but the market salary of a manager, which we need to replace you, right? We need to replace you, is Y. So if that's the case, then the profit, the EBITDA goes down to 300,000, for argument's sake, right? Because I need to pay an additional £50,000, $50,000, 50,000 euros to a manager to replace your role. And like I've said in previous videos as well, is that business owners are normally operators. I'm talking about here, not investors, of course. Business operators, owner operators, are normally doing the job of 1.5/2 people. So you need to make that adjustment. And they may be running things in their business which are not true business expenses. And if they're not true business expenses, you need to make adjustments. So just for illustration purposes, we're going to say that after all of the adjustments that have been made, look, you're buying the future cash flows of the business. And when I say cash flow, I'm using EBITDA here, right? So I'm going to use these two terms interchangeably. I'm buying the future cash flows of the business, and let's say the future cash flows of the business work out to be 250,000, right? So even though once you work out their current EBITDA is 350, the forward cash flows of the business is 250,000. If the forward cash flows of the business is 250,000, then you need to work out what is going to be, you need to make your offers based on that, right? So your offer is going to be based on this. So offer base, right? It's going to be based on the 250,000, not the 350,000. And I can tell you right now, a lot of business owners, they're just going to be put off at this stage, right? So let me try to give you a metric. So when me or my clients are speaking to business owners and they make this EBITDA adjustment of future cash flows, then you normally lose about 30% of sellers just right there, because they're not willing to accept. In fact, let me tell you right now, yesterday I was speaking to a business owner. So me and my colleague, one of my directors, I didn't really understand. It was an aesthetics clinic, right? An aesthetics clinic. So I don't really understand the business as much as that. So I got one of my colleagues to come onto my directors to come into the meeting with me. It was an initial meeting. And so that person, so when you're doing aesthetics, you have to be medically qualified. So the person who was the business owner was a doctor. Now we saw that there was many other aestheticians, if that's the right way of pronouncing it, who worked in the business. And what we wanted to understand is that, can those aestheticians take over any sales? So first of all, we need to determine the sales relationship. Now I've covered this in previous videos, but I'm just re-illustrating for this example. So we had to determine, is the business owner doing any of the sales? So it turned out that the business owner was doing about 50% of the sales of the business. Now that business was turning over about 1.5 million in revenue. So that means about 750,000, around about that number, was being generated by the business owner themselves. And there was no one to replace them, right? There was no one to replace them. So now, to be perfectly honest, I don't have the time and the patience to deal with these kind of people. So I ended the meeting 5 minutes later, just out of respect, to let them talk, finish, and it comes to a natural pause in the meeting. And I said, thank you very much. I didn't say we're not interested. I said, I'm going to contact you in future. And I sent an email almost immediately saying that thank you very much. It's too owner dependent. We're not interested. But anyway, so like yesterday, there was such a huge amount of the turnover that's being generated, and it's going to go, by the way. So there's no natural person to take over the sales that the owner was making. So the adjustment needs to be made, and that's why even if we said that we want to go ahead with the business, the valuation base, the EBITDA base that we would be basing it on would be too low for the seller to accept. Because in her mind, when I asked her how much does she want for the business, she said to me 800,000, right? She wanted 800,000 for the business. But how can you pay 800,000 for the business when the business, after she leaves, is only making, and I didn't make the calculation, so let me just quickly make it right now. So I think it was making about 400, it was making 300, and then if we halve that, right, by the way, halving sales doesn't mean that you're halving the profit. Halving the sales could mean that you're wiping the profit out completely, right? So let's be generous. Let's be generous that her 300 went to 150. Now we're going to do a 2 to 3 times multiple on that, possibly 4 if we're going to be. Now I don't never do that, and we're going to talk about offer framework in a minute. And let's say, for example, we offered 3 times multiple, which is kind of the max that we normally offer. Right? So what's that? 150, 300, 450,000. That's half of the price. That's half of the price that she was expecting. And that's what I'm saying, is that she would have dropped off herself, because she's a doctor. She's making good money herself. She sold so she had a different business which was attached to this business, and she had sold a business previously. So she's a little bit more sophisticated because she sold a business. Now, if she's set her mind on 800,000, she's actually gone through some sort of valuation calculation in her mind, but our distance would be too far. And by the way, if you wanted to go ahead and make an offer on that business, you would go and negotiate. But I don't have the patience for that. So I said, thank you very much, and on your way. So that's what I'm saying, is that a lot of business sellers, about 30% of the business sellers, will end up dropping off just by you recalculating the EBITDA of future cash flows, right? So that's the first thing. Agree a profit number of future cash flows. Let me put this here. Of future cash flows. I think this pen is running out, so let me get another one. Of future cash flows. Don't worry about what the business is doing right now. You need to adjust it. Now, by the way, I've said this previously. If you're an owner-operator, you've got a little bit more flexibility, because you're going to be there and you're going to be the one who's helping drive the business forward. So maybe you might accept 350,000. Yeah? Okay, you know what? If they're doing X, Y, Z, I know I can do that as well. And in fact, I can do it better than them. So if I can do it better than them, then I'll accept the 350,000. By the way, you should, because you want to get the best offer that you can for yourself. You don't want to overpay, or even overpay. You don't even want to pay the top end valuation, the correct top end valuation. You want to pay a good price for yourself, right? Because as soon as you pay a lower price, you've de-risked your acquisition a little bit more, because you're paying a lower price, and therefore you have a bit more margin of safety. So as an owner operator, you always have a little bit more flexibility. But as an owner investor, for example, like myself, I don't have no flexibility. And in fact, I'm extremely inflexible. When it comes down to understanding the forward cash flows, the forward EBITDA of a business, I'm very inflexible. And by the way, if a seller disagrees with me, I'm happy to hear that, right? So if they say to me, no, your calculations are incorrect, and actually the EBITDA is going to be 300,000, and it makes sense. And by the way, I think in all of my dealings that I've had with like hundreds of business sellers, right, maybe I can only think of one, but I think that's too low. There's probably been 2 or 3 where I've said, yes, okay, that's fine. I accept your recalculation of my initial calculation, and I accept that the future cash flows of the business is going to be higher than what I had initially said. But that doesn't happen very often, because of course, the reason why they would be correct over me is because of some sort of nuance in the business which is going to continue post-acquisition that for some reason I missed or I didn't understand. And that's very rare. Okay, so let's swap this pen out. Where's my other pen? Let's have a look. Is this going to get better? Yeah, there we go. So already better. Right, so we are looking at agreeing the profit number. So we've agreed the profit number, the forward cash flow of the business. Now what do you need to do? Now before we go into what you need to do and any interactions you might have with the seller, there's something that you need to do for yourself first. So let's get rid of this. And by the way, what I'm going to say here can change. So initially you might do something, but you need to create an offer framework. An offer framework. Okay? I'll explain what this means. So every business, any business company which is doing business acquisitions will have an offer framework, or they should have an offer framework. And if they don't, they're missing something, right? You're watching this video, so obviously you understand. So an offer framework is what are the metrics that you're willing to work within. Okay, what are the metrics that you're willing to work within? So I can tell you right now is that I'm willing to work on these metrics. 2 to 3 multiple of EBITDA. What do I mean by that? Is that what offer am I willing to make? 2 to 3 times multiple EBITDA. Now, in all honesty, actually, you know what? Let's make it more realistic. I'm willing to go to 3.5, but I'm never gonna tell a business owner who's selling their business that I'm willing to go to 3.5. I will tell them that I'm willing to go to 2.3. And by the way, there's something about honesty, right? If you're completely upfront and honest about things, the seller's going to appreciate it, right? Now, don't forget, you're sitting across the table or across the Zoom table, whatever, with people who have been normally running their business for 10, 15, 20 years. Now, that doesn't mean that they're sophisticated business sellers, because they're not, right? Very few. I've only come across like 3 people who have previously sold businesses and really understand M&A the same way that I do, or maybe to some extent that I do. So, but they are business people, right? So they do appreciate honesty and also openness with regards to the metrics that you're willing to work in. So I say to them, right, I'm willing to work at between a 2 to 3 times EBITDA. Now, by the way, when I say this, I give the framework and I say, I don't know where your business falls within that, because I need to find out more, right? I need to find out more. So that's the caveat. So I'm willing to work between 2 to 3.5 times EBITDA. Now that's my internal framework. I don't tell them that. Then we say that we're never going to pay cash, 100% cash. So we're never going to pay 100% cash on completion. On completion. The next thing we're going to do is that we're going to say, right, that means that there's going to be some sort of payment up front and some sort of deferred. Now, by the way, you have to gauge this from the seller. If they're super motivated, then you don't say, I'm going to pay you 50% up front. You have to really understand that. But let's say, for example, in any normal space, in any normal place where you're dealing with someone who has a good, profitable business and they are motivated, but they're not like super motivated. What do I mean by super motivated? They're about to drop dead tomorrow, right? They have to sell, or they have to immigrate tomorrow for some reason. I don't know, whatever reason, right? So let's say, for example, I say to the person, because this is the normal conversation that I'm having, because I don't go for crap businesses, right? I go for good businesses. So these people have got good business. I say, right, I'm willing to pay either 50% to 70% upfront. Now, like I said, if I can see that a person's motivated, then I'm not going to tell him that I'm going to pay 50% up front. I'm going to tell him that I'm going to pay 0 up front, or I'm going to pay 10% up front, or I'm going to pay 30% up front, or I'm going to pay 40% up front, right? But most of the people that I'm speaking to have good, successful businesses, and they are motivated, but they won't accept 10% up front, so there's no point even mentioning it, right? Now, okay, there is a point mentioning it, but we can do this afterwards, because once you find out a little bit more regarding the operations of the business, or the finances of the business, or the legal framework of the business, then you can say, no, I said 50%, but by the way, there's all of this risk, right? So I have to bring that down to 25%. I have to bring that down to 20% on your way. But if I do that, I'm going to justify it. Just like I'm being open and honest to them with regard to the offer framework, that means that I have to be open and honest with them with regards to the problems that I'm seeing in their business. And if I'm seeing the problems in their business, then of course we need to convince them that this is the problem. Even when you're buying a business, it's a sales relationship. Yes, it's a sales relationship because you're selling the person on a lower future cash flows, you're selling the person on taking a lower price for the business, you're selling them on taking a lower payment up front, right? So if they, for example, you find problems, you can do that later. Anyway, so that means that there's going to be a deferred element. So, and I normally say that I don't like paying more than 50%. It has to be some solid reason why I'm going to go above 50%, okay, up front. So that means there's going to be a deferred element, and the deferred element is going to be paid. It can be anything from over 4 years plus deferred, right? I don't go, why do I keep misspelling deferred on this board? So annoying. Right, deferred. 4+ years, okay, you don't see what that is. 4+ years deferred. So now they have this framework. And if they're not willing to work in that framework, thank you very much. Best of luck with your business sale. Plenty more fish in the sea. Right? So if you're willing to work on that framework, let's have more conversations. If you're not willing to work on that framework, on your way. Yeah? Simple. Look, there are plenty more businesses out there for you to acquire. Good businesses. So this is the frame. Now, by the way, I'm willing to break my offer framework if a fantastic business comes along, which is a big business, and maybe it's an opportunity of a lifetime. You know, Charlie Munger, he says, right, and remember, my framework is a value acquisition system, the value acquisition framework, which is based off value investing principles, of which the grandfathers are Warren Buffett, Charlie Munger, right? These guys are the value investors. Obviously, Charlie Munger's dead now, but anyway, Charlie Munger says that you have to be, so we're talking about marriage, right? It's talking about, okay, you find your spouse, you find your wife. You have to be willing to, or you have to accept the best person who's available to you. You have to accept the best person who's available to you. I said, if you have a business that's come across, it's a once in a lifetime opportunity. You don't mind breaking your offer framework for that. So be like, you know what, I will pay you 80% up front. Now, by the way, you should always have a holdback. You should always have a deferred element. And that's de-risking and also having some buy-in from the seller, right? So that's why I say never pay 100% cash on completion. Now, when I say never, I mean anything which is a small business. And you need to watch the M&A Masterclass, Introduction to M&A Masterclass, M&A Strategy Masterclass, if you want to understand the different sizes of the framework or different sizes of businesses. You need to know what a small business is. So if it's a mid-cap business, and preferably a mid-cap business or upper mid-cap business, then you might, and if you can get the financing for it, then you might want to pay 100% cash on completion, because those businesses are very big. You're talking about business which is 100 million plus in revenue, or 50 million plus in revenue, right? Those businesses don't come about very often, and how often they're going to come on your table. That's your offer framework. You need to make your offer framework. You need to understand your offer framework. And by the way, this offer framework might not work for you, because if you're in the medical industry, then the 2 to 3 times you might not complete acquisitions. And by the way, look, I can be a little bit more stubborn with regards to my offers that I can make, because people now know me. They know I can get deals done, and I don't mind waiting to get a good deal. Right? Value acquisition framework system is that when you do acquisitions, it doesn't matter if you only do 2 or 3 acquisitions in a year, but those acquisitions really move the needle, right? So in the last Berkshire Hathaway annual meeting that Warren Buffett had, obviously it was the first one without Charlie Munger. So Warren Buffett, he done a lot of reflecting this year, okay, because his best friend died. So he done a lot of reflecting this year. And Warren Buffett, he's done like hundreds and hundreds of deals, even though, for example, he's also, slow, and that's where I get the system from, or base my system off. Even though he's slow on the deals that he makes, he said that in his entire lifetime, that he's been investing, and when I say entire lifetime, I mean entire lifetime of Berkshire Hathaway. So Berkshire Hathaway has been around for like, I don't know, I think it's about 50 to 60 years. So we're talking about an entire lifetime, right? Because how many people are working for 60 years? He said that there was 11 decisions that he made and 11 things that he done in investing and in business that really made the difference. 11 out of the hundreds of deals that he's done, and he's a multi-billionaire. Yes? So when you make those acquisitions, then depending on your industry, you might need to be a little bit more, you need to be different about your framework. So if you're in tech, 2 to 3 times EBITDA is never going to work. Tech businesses are valued higher. So you're going to have to start, for tech businesses, you're going to have to start at 3 times multiple. That's the starting point. Then that goes all the way up to like 12 times multiple. Depending on the biggest businesses. Now, obviously, if you're starting out your first acquisition, where are you going to get money to do 12 times EBITDA multiple acquisition? It's highly unlikely. Unless you're already a high net worth individual, or you have a network of high net worth individuals, or you raise the fund. You know, SPACs out there, what they're doing is that they're raising billions. We're going to buy a business, and we're going to buy a business which is huge. We're only going to buy one business. Maximum, we're going to buy like 3 businesses. But those businesses, the first business acquisition is going to be so huge, humongous, massive acquisition that even if we don't do any acquisitions in the future, it's going to be enough. So then they're raising a huge fund to be able to do a massive acquisition. That's a different framework and methodology of going out and doing acquisitions, right? So SPACs is another way of doing it. Anyway, we're digressing to other topics. So let's move back to making initial offers. So once you've got your offer framework and people are willing to have conversations, when I say people, business sellers are willing to have conversations with regards to your offer framework, then you can have a further conversation. Now, bearing in mind, when you're buying a business, you're trying to get the best deal for yourself. Yeah? That's what you're trying to do. So, it's offer framework. So for your initial offer, what you need to do is you need to always go low initially. So even though, for example, always go at the lowest that you can without offending. And by the way, a little bit of offense is fine. When you're making offers, a little bit of offense is fine. So go as low as possible. Make low initial offers. And why is that? Because 9 times out of 10, it's going to be rejected. Look, if you're selling something, right? Let's say, for example, you're selling your car. Someone comes in, it's standard, they're going to make a low offer, you're going to reject it. Yeah, that's just like business negotiation 101, right? 101. Completely foundational level, never accept your first offer. So that's why if you go in too high as a business buyer, then you're shooting yourself in the foot, right? You're shooting yourself in the foot. So go as low as possible. So if, for example, they've got let's say, for example, you've had a meeting with them and they said, right, I want, and let's take this woman, 800,000 for the business. Let's say we were interested and we want to go over. I would probably offer her half. Okay, I would offer a half. That's where I would go. So I would go in half, yeah? And then you get rejected, no problem. Because now you can start working off that base. So that woman wanted 800,000 for her business. Okay, I go in and I offer 400,000, right? Now she's got in her mind. And by the way, there's one of 2 things that can happen now, right? There's one of 2 things. Let's say I go in and offer 400,000. And by the way, what you want to do is that you want to offer or you want to give the offer and also the framework of the offer as well, the structure. No, it's not the framework, the structure. The structure of the offer at the same time. So say I'll give you 400 total price for the business, but I'm going to give you 200k on day one, right? 200k cash on completion, and I'm going to pay 200 grand over 5 years. Over 5 years, right? So that's how you want to break down your offer. And you know, because you've already agreed a future cash flows of the business. Now, by the way, if you want to be extremely efficient and you can do this, you can say, right, I'm going to give you the forward cash flow that we have is, I don't know, 200,000, right? That's the forward cash flow. that we worked out. And that's why we're going to give you 400, and we're going to give you 200,000 cash on completion, and we're going to give you 200k over 5 years. Because now what you've done is that you've given them the baseline profit number, you've given them the total valuation, and you've given them how much they're going to get on day one, and you're giving them how much they're going to get over time, right? Then what's going to happen is that they can either completely say, no, I'm not interested, thank you very much, I never want to deal with you again. And in that case, no harm done. Because what? There's plenty more fish in the sea. No harm done. So by the way, there's one business that I made an offer on, and it's still on the market today. I made an offer on it like 5 years ago or something, yeah? And that business is still on the market today. It's owned by some young guys. When I say young guys, they're like relatively young. Back then, they were like 50 something, yeah? So they're probably pushing, you know, late 50s right now. So they're not super motivated because they've got enough energy to continue running the business. But I went back in, I think it was like last year or 2 years ago, I went back in and I tried to make a, you know, restart the conversation and said, we're not willing to have a conversation with you. So basically, the offer that I had made, right, which was an almost embarrassing offer, low initial offer, was bad enough for me to burn the bridge in their mind. Right, was bad enough to burn the bridge in their mind. And that's no problem because there's no multiple acquisitions thereafter. So that can be the first response. Bridge burn. I don't want to talk to you again. Don't even come back to me. Or the second response, which is 90% of the time or 80% of the time what happens, is that they say, no, we can't accept that offer. Do you want to make a re-offer? Now, we're going into a slightly different conversation now, but you never want to negotiate against yourself. And we'll break that down a little bit further later on. So we're going to come back to that. So that's your initial. So they say no. Best response, if they say no, let's put this there. So once they rejected, you ask them, okay, bring me a counter offer. Bring me a counter offer. So what you're now trying to do is that now that you've built that low base, you're asking them to say, come back to me with something that you're willing to accept. 800,000 was that woman. She might come around and say, I'm willing to accept 750. Because of course, you're trying to go as slow as possible up, and they're trying to go as slow as possible down, right? So 750. And then there's some negotiation which happens, and then you can do, like, there's so many things. Now, this is why you need to work with an M&A advisor. And of course, if you are a business owner or a investor with significant capital, get in contact and I can help you with implementing these things in the real world. So you can adjust the cash on completion. You can adjust the deferred element. Again, it depends on the situation. You need to gauge the temperature of the seller. And once you gauge, and you need to gauge the temperature of the negotiation. So this is, you know, you can't talk about this in a video, right? It has to be done in person and in the moment, really, yeah? So that's why I work with people one-on-one. Now, coming back here is bring me a counter offer. So let's actually go into never negotiating with yourself about bringing a counter offer and so on and so on. So you get the point, make a low initial offer because your first offer is going to be rejected 9 times out of 10. So then you're going to be into a negotiation. So now let's get into a negotiation. Very, very elementary points here. And you need to work on your own timeline. If you go to my YouTube channel, you'll see where I did a reaction video to the Sell Side M&A Masterclass by Potomac. Fantastic video, by the way, by Potomac. So thank you very much, Paul. But I did a reaction video and he talks about controlling the timeline on sell side, right? And what you want to do is that you want to control the timeline and you want to control the temperature and the process of the negotiation. So once you got control of that, then you can start, you know, doing things for your benefit. Now, if they say, right, you say bring me a counter offer. Yeah, they say make another offer. Right, I am never willing to make another offer. Yeah, I'm never willing to make another offer. And if I'm going to, by the way, if I'm going to make another offer, it's going to be like marginally higher than the previous one. Marginally higher. So I'm going to say, look, we're going to go back and forth forever. if you want me to make an offer and then make a re-offer and do this and do that, why don't you just tell me what you're willing to accept? Yeah, what you're willing to accept. So then they're going to turn around the price and they're going to say, all right, I'm willing to accept. Let's say after a bit of back and forth, they say, right, we're willing to accept 600,000 for the business based on that 800,000 price that that woman wanted for the business. And we want 100% cash on completion. Say, look, I'm not going to give you 100% cash on completion because there's risk. Every single business acquisition is a risk. So how do I know that the businesses are going to continue to generate the profits and generate the revenues and the staff members are going to stay and all your customers are going to stay? What guarantees are there? There's no guarantees. I'm taking all of the risk here, so I have to have a holdback, right? I have to have a holdback. So then you do that negotiation and you come to some sort of offer framework that they're willing to accept. If you make another offer, all you're doing is that you're increasing your price. You don't know where the ceiling is on that. Yeah, you can end up massively overpaying for the business, and you didn't do that. Now, one of the best things that you can do, and I do this a lot. Now I do it more than I used to when I started out. But if you can do it when you start out, then it's going to be better for you. When you start out, you should adopt some of the things that I'm telling you here. Pull out from the deal. So look, clearly, I'm not going to write the whole thing. You basically say, clearly, there's too much gap between what we're willing to accept or what we're willing to pay and what you're willing to accept. So thank you very much about, come back to us. This is almost the exact wording that you have to say. Come back to us if you're willing to, accept the offer close to where we're making it. So when you pull out, something happens. Pull out of the deal, something happens. Actually, either one of two things can happen. In fact, either they go and they sell the business to someone else, and no harm done for you. Why? Because they're plenty more fish in the sea, as always. Or they can come back to you because they can come back to you. And when they do come back to you, let's say, for example, you say, right, no problem, I can't do this, and go in the open market and sell. And if they come back to you 2 months later, 3 months later, guess who's got the power? Guess who's got the leverage? You as a business buyer. Just because you pulled out. So I do this a lot now because really and truly the size of my business right now, I can continue running it and or continue having the business at the size it is right now and never make an acquisition again and be pretty happy, right? I won't be super happy because humans continuously want more. But if I make more acquisitions, I'll be happier. But I can keep my business as it is and forever own it as it is and be happy. So I can do this a lot more now. But if, for example, a seller comes back to me and says, you know what, I've been on the market for 3, 4, 5 months, 6 months, 1 year, 2 years, 5 years, whatever it may be, and I'm not being able to sell it, are you still willing to do a deal? You have all of the leverage and all of the power, and that's the best position that you can be in because you've made offers. And by the way, remember, if you go low, and that's the benefit of going low, because you went low, they rejected it, they kind of know what your position is on their business, and as long as basically the metrics haven't changed, because of course businesses can go up and down accordingly, so you do a reevaluation, but in terms of your framework, you stick to the same framework, or you in fact use the same framework. So they came back to you 6 months later, or 1 year later, 2 years later. They're basically, what they're saying indirectly is that we're willing to work on the terms that you had initially proposed. Let me repeat that. They're basically saying to you when they come back to you after some time of not having sold the business, saying we're willing to accept the terms that you had laid out initially, and therefore you can go even lower and have better terms, because now it also shows you that there's no one else who's buying their business. You are willing to buy their business, and by the way, there's question marks with regards to that, and that's a whole different conversation which I'm not going to go down to. Why are other people not willing to buy their business? Where you are you not seeing something? But that's a different conversation. But if you are willing to, and all things are good, and you are willing to buy the business because it does check out, now you've got the power, you can go even lower and have a better deal for yourself. So that's why make initial offers low, have a set framework, deferred elements, so on, and then you can have that buying power when you're going out. And then they go out, they say, no, we don't want to deal with you, no problem. If they do come back to you, you've got the power and you can get a better deal for yourself. Right, a few things to consider when you're doing negotiations. So, does it still fit? Does it fit in M&A strategy? Remember, you have to have a clear strategy of how you're going to do your acquisitions. That you can go and watch the M&A Masterclass that is in this series on YouTube. Does it fit in the M&A strategy? That's the first question. If it does, then you can continue. Does it fit the deal specification? Remember, don't ever specification. You can move up in your specification, but never move down in your specification. Unless you're getting a blinding deal, right? Once in a lifetime deal. So once you have offers, right? Once you have making offers, and especially when you got the offer accepted, then you need to look at, will investors give me money on this deal structure? Because look, investors will, in principle, say, right, we're happy with you, we're happy with your industry, we're happy with what you want to do. But then now the deal comes along, and the deal framework or the deal structure doesn't work for them. So you have to think, okay, will investors give for this structure? Yeah? Investors and lenders, whoever you're dealing with. And if they will, that's fine, good. Okay, so what's going to be the debt service coverage ratio? Does it fit in the DSCR? If it does fit in the DSCR, look, when you're buying, actually that's the most important thing. You have to make sure you got positive cash flow, right? If you don't have positive cash flow, you're basically shooting yourself in the foot and then dying 2 months later. So does it fit in the DSCR? And if it does fit in the DSCR, to what level do you have margin of safety? And in a nutshell, the higher DSCR, debt service coverage ratio, the more margin of safety. You have to watch my other videos to understand exactly what that means if you don't understand it right now, because I'm not going to get into it. I don't have enough time. I have to end this video very soon. So DSCR, the higher the DSCR, the more margin of safety, and that's good, because then you can either take that money for yourself or you can reinvest it to future acquisitions or whatever future growth of the business. So that's when you're making initial offers. In a nutshell, go low, have an offer framework, make sure DSCR is covered, make sure the investors will give you money, never negotiate against yourself, be willing to pull out, and be willing to be open with business sellers. So this is in a nutshell. There's so many other things, of course, that you need to understand. This is where, by the way, everything up until this point has been pretty easy. You can do it behind a desk. But now you get into the meat and bones of M&A. Right? Now you need to have skill. Yeah? And this, by the way, the initial offer, that's where 70% of your deals are going to die. When you're searching for businesses, that's where 95% of the businesses are going to die. But then once that's, come past there, about 70%, 60%, maybe that's a bit too high, but anyway, okay. Let's say 50% of your deals are going to die in the offer stage because the seller's not willing to do an offer. And like I said, willing to or accept the offer, be willing to pull out and tell them no problem at all, go into the open market and then come back to us. And if they do come back to us, then you've got more chance of getting that deal done. By the way, when people have come back to us, we've closed the deal 100% of the time. I'll repeat that again. When people come back to you, then you will close the deal about 100% of the time. Let's call it 90. You can't ever say 100% anymore, right? 100% gives you trading standard issues. I'm not selling you that you will go and buy a business. Look, buying a business is effort from your side. You have to put effort in, and if you don't put effort in, then you can't do a deal, right? So, and you have to have the right advice, the right strategy, and right everything. So you're watching videos on this channel. Carry on watching videos on this channel. You can watch this video that's popping up here. You'll learn everything about value acquisitions, enterprise value, and also exiting businesses. And I'll see you in the next video.